Welcome back to Money Logic. If this is your first time here, I'm glad you're watching. Let me ask you something, and don't rush to answer it. When you hear the word investing, what do you feel first? Not what you think, what you feel. For most people, it isn't excitement, it's tension. A slight tightening in the chest. A sense that one wrong decision could undo years of hard work. And that reaction makes sense. Because when people think about investing, they imagine uncertainty. They imagine loss. They imagine regret. You open an investing app, prices move up and down. Percentages change every second. Your brain doesn't interpret this as long-term wealth building. It interprets it as danger. Here's the first idea that changes everything. In finance, risk is not volatility. Volatility is simply movement. Prices go up. Prices go down. Risk is something else entirely. Risk is the chance of a permanent loss of capital, or being forced to sell at the worst possible time because you need the money. Most people are not afraid of investing. They're afraid of losing control. In the previous episode, we talked about financial security, about understanding your cash flow, building liquidity, reducing fragility in your life. If that foundation isn't in place, investing feels painful. Every market movement feels personal. But once stability exists, investing becomes something very different. It becomes calm. It becomes logical. It becomes boring. In a good way. That's what we're going to talk about today. Not how to get rich quickly, not how to beat the market, but how to invest in a way that feels sustainable, rational, and stress-free. Most people approach investing the wrong way. They treat it like a prediction problem. They ask questions like, is this the right time to invest? Should I wait for a crash? Which stock will perform best next year? These questions sound intelligent, they sound responsible, but they create anxiety because they assume something that simply isn't true, that the future can be reliably predicted. Even professional investors struggle with short-term forecasting. Entire teams of analysts get it wrong again and again. This is called forecasting risk. The more you try to predict markets, the more emotionally involved you become. And emotional involvement leads to something far more dangerous than market volatility. Behavioral risk. Behavioral risk is when you become the biggest threat to your own portfolio. Panic selling, chasing trends, abandoning long-term plans at exactly the wrong moment. This is why two people can invest in the same market with the same returns available and end up with completely different outcomes. Not because one was smarter, but because one stayed calm. So, let's reset the entire mental model. Investing is not gambling, it's not trading, it's not excitement. At its core, investing is capital allocation. You are taking money you do not need today and deciding where it should work for you over time. When you invest, you are buying ownership in productive assets. Real businesses. Businesses that sell products, employ people, generate cash flows. You are not betting on tomorrow. You are participating in long-term economic activity. This is why investing rewards patience far more than intelligence. Once you understand this, investing stops feeling mysterious and starts feeling practical. Let's talk about Warren Buffett. Not because he's famous, and not because he's wealthy, but because people misunderstand why he succeeded. Most people think Buffett built his fortune through brilliant stock picks. That's only a small part of the story. Buffett's real advantage was time. More than 90% of his net worth was created after the age of 50. Not because he suddenly became smarter, but because compounding accelerates over long periods. Compounding doesn't feel powerful in the early years. It feels slow, almost disappointing, but over decades, it becomes extraordinary. Buffett also understands something very important about markets. Markets are largely efficient. This idea is known as the efficient market hypothesis. It means that most publicly available information is already reflected in prices. Markets are not perfect, but consistently beating them is extremely difficult. That's why Buffett often says something that surprises people. That most investors should use low-cost index funds. Not because they're exciting, but because they remove unnecessary mistakes. Buffett doesn't chase brilliance. He avoids errors. That mindset is far more powerful than it sounds. Let's bring this down to real life. Imagine someone named Sarah. She earns a stable income. She's built an emergency fund. She understands her expenses. She doesn't watch markets all day. She doesn't read financial news every morning. Instead, she invests a fixed amount every month into a broad market index fund. Some months the market is up. Some months it's down. She invests anyway. This is called dollar cost averaging. Professionally, it reduces timing risk. Emotionally, it reduces stress. She's not trying to buy the bottom. She's not trying to avoid every downturn. She's building a habit. Over time, volatility becomes a background noise. Confidence replaces anxiety. At this point, something important needs to be said. If you want to truly understand investing, not just do it, but feel calm while doing it, books matter. Not social media, not headlines, not hot takes. Real investing knowledge comes from long-form thinking. There are a few books that professionals consistently respect. The Psychology of Money by Morgan Housel. It explains why behavior matters more than intelligence, why patience beats brilliance, why most financial mistakes are emotional, not technical. The Little Book of Common Sense Investing by John Bogle. This book explains why low costs, diversification, and discipline outperform complexity over time. A Random Walk Down Wall Street by Burton Malkiel. It explains market efficiency in plain language, and why trying to outsmart the market often backfires. Notice something important. None of these books promise fast money. None of them sell secrets. They all emphasize structure, patience, and humility. That's not accidental. That's how real investing works. Now let's talk about one of the most important concepts in all of finance. Asset allocation. Asset allocation means deciding how much of your money goes into stocks, bonds, and cash. This single decision drives most long-term portfolio outcomes. It determines how volatile your portfolio feels, how deep drawdowns can be, and how much growth you can reasonably expect. Professionals spend far more time on asset allocation than on picking individual investments. Because structure matters more than prediction. Structure creates stability. Stability allows consistency. Consistency allows compounding to do its work. Here's the final distinction to understand. Volatility is not risk. Volatility is movement. Risk is not being able to meet your future needs. When your emergency fund exists, when your cash flow is stable, when your investing money is truly long-term, market movements lose their emotional power. You stop reacting. You start investing like a professional. Let's zoom out. Money is not about status. It's about freedom, peace of mind, time, health. Financial security gives you stability. Investing grows that stability over time. Slowly, calmly, intentionally. If this video helped investing feel clearer and less intimidating, subscribe to Money Logic. This channel is about personal finance done properly. Without hype, without shortcuts, without stress. In the next episode, we'll talk about how much you should invest and how professionals think about asset allocation by age and goals. And before you go, think about this. What part of investing still feels uncomfortable to you? Understanding that question is the first real step toward financial confidence. See you next time.